let's keep it with the earnings, Anisha. Today we have a whole host of managements joining us on the show. And Westlife is a company which has reported a good set of numbers in quarter three. Overall, you look at it, the delivery also is clocked the highest ever revenue as well. SSSG growth is coming in at 44% on a YOY basis as well. So let's bring on board the management. We have Amit Jatia with us, who's the Vice Chairman at Westlife Development. Thank you so much, Mr. Jatia, for joining in with us on the show today. And firstly, I'm obviously going to start by talking about the margins. Now, the company has actually seen an expansion coming in the margins, and this is despite the inflation that we've seen. So, what has aided your margins, and, how sustainable are these levels of margins going forward?
Well, I mean, firstly, if you look at history, pretty much pre-COVID, every year for 5 years, we improved our operating margin by 130 basis points. So I think from a history point of view, we've demonstrated that what we do, we are able to sustain and take that forward. Specifically in this quarter, primarily, of course, it's driven by volumes. And our average unit volume has now crossed about 6 crores on an annualized basis per restaurant per year. And essentially what that does is, it was, of course, on the account of chicken that I had talked about even in the last quarter. So fried chicken's been doing extremely well, adding a lot of incremental sales to our restaurants. On top of that, we launched the gourmet burgers, and that, along with, of course, cost management, is a reality in a high inflation market. And the two coming together has led to both top line growth, 47% year on year and 44% same store sales growth, which has helped us therefore do flow through right to the bottom line. We are quite delighted with that.
Hi, Mr. Jatia. Good afternoon. Anisha this side. Well, our colleague Kritika was talking about how the footfalls have improved in the last few weekends and weekdays, given the fact that lockdowns have eased. Is this something that you can corroborate for us?
So, I think what I'm very happy to say that we are on a very, very, very solid wicket in a way. Why I say that is that our brand has pivoted to become an omni-channel brand. So as you can imagine, last quarter, as restrictions kept reducing, essentially in-store started coming back. And as I had maintained earlier, even with in-store coming back almost 40-45% growth, our convenience channels, which is driven by delivery, takeaway, drive-thrus and all of that, also grew by over 50%. So essentially, we got growth on both sides, and that has put us on a very, very strong wicket for the future. So even though, if you think about it, October, half of it was shut. December, the last 10-15 days, all the shutdowns had started. And of course, this year has started with this quarter, that is particularly January, started with shutdowns. While we cannot talk about the coming quarter, but we believe that this channel pivot will help us and put us in good stead for the quarters ahead. So we are quite hopeful that this will be retained.
Jatia, so I just do want to understand it in terms of, obviously channel-wise, you said the channel pivot will help you. But, what is the percent of sales then you would say actually is coming from dine-in, and how much is coming from delivery and takeaways as of now?
Primarily, almost 60% of our business is still off-premise, while about 40% of our business is on-premise, which is the in-store dining.
Sure, Amit, if you can talk to us about your expansion strategy as well. Are you looking at deepening your presence in the tier 2 and tier 3 cities going forward?
I mean, I think we followed quite a robust strategy, both from a real estate point of view as well as the way we have penetrated the market. We pretty much own the markets we've been in. And our philosophy has been to go and keep opening restaurants in the same market, so we gain market share and customer acceptance. So the good news is, in a way, that we are only in 46 cities. So we have at least another 100 cities to go to. So that's the positive side. We believe that going forward, we opened about 8 restaurants in the last quarter. We already have 12 restaurants in ground break in the quarter we are operating in right now. And the idea is to accelerate the openings to take about 500, to take our base to about 500 in the next 3 years. Essentially, the plan is to continue to open in our current markets and also add at least 20-25 new small cities, taking the base from about 45, 46 to about 70. So it's going to be a mix of both, but we don't want to ignore our current markets at the same time.
Now, Mr. Jatia, I'm just going to ask you a bit more on your expansion and growth strategy plans for going forward. What can we expect from Westlife going forward in terms of growth, and in the next quarter, what can we be expecting from the company?
I mean, in our opinion, we believe we are aggressive, but it has to be sustainable and predictable. So the idea is that we want to open 200 restaurants in the next 3 to 5 years. We have put out an investment plan of almost 800 to 1,000 crores. And as we take our average sales per restaurant per year up from the 6 crores to the 7 to 8, the idea is to therefore grow our operating margins quite nicely as well. So while I don't talk quarter on quarter, but year on year, we at least like to see 100 to 150 bips improvement over the previous year. So I think we will continue to maintain this trajectory. So you will continue to see Westlife very steadily, giving these kind of results quarter on quarter.
Okay, Amit, thank you so much for joining us with that entire perspective on your expansion strategy, the situation on the ground at the moment, and the outlook going forward.